reaction at the moment. There's nothing that should be market reacting. It's going to be the aftermath, whether we get a date for the actual election coming in. It's all pleasantries and that sort of stuff. Well done, by the way, on your analysis there on the Dow and whatnot. You called it to a T over that lot.
Thanks, Ryan. So so the dollar is drifting lower. Does its action, and I know you're probably still long, right? There's no reason to get out of your longs except that it's boring.
Yeah,
that's not a good reason to get out of a trade, is it?
No, not one that's in profit. No, certainly.
Yeah. So, are you impressed with this action? I mean, we've had tremendous moves in gold and yields, and this kind of like a grinder.
It is a bit of a grinder. There's things pointing. The data we had from the ISM yesterday, that employment number, got a bit of a wobble, put a bit of a wobble in the market, particularly as we got NFP this week. We got jolting a bit later on. We got ADP in 10 minutes. There's the dollar's seemingly a bit on the back foot at the moment, but like you say, it's grinding. We're not, it's taken 3 days for euro dollar to move 20 pips.
I mean, volatility is very compressed, isn't it? I mean, we're hardly getting ranges now.
Yeah, 5.73%. We've got 8.5 billion options rolling off between 108.30 and 108.70 today. So, the option players are really trying to squeeze the pips out of this low vol.
Right.
And just trading around these close ranges. But we got Powell coming up. As I say, we've got the data coming up. So, it's like these markets. ADP comes in at plus 300K and Jolts goes higher and Powell's bullish and, Euro's trading back near 107.50 or 107, let alone 109. So,
So it's a waiting game, or if you're positioned light and where you're going to liquidate and where you would add on.
Yeah, exactly.
Right.
Exactly.
Okay. Kman, how are you today, buddy?
Good morning, Dale. Good morning, everybody. I hope you feel okay, Dale.
Yeah, right now I do.
All righty.
So yen, it's got a little wick on it here.
Yes. There have been some comments, call it sources, call it people close to some stuff that keeps or tries at least to keep the door for actually a March hike open from the Bank of Japan. So the market reacted to that, and we were talking about it on the flow show. It does look like going into next week, wage results, possible results, because Toyota will give their answer as well on the 13th to the wage hike demands. There may be some speculation coming in the market that we could have a bit of a trigger. Now, it may have been a bit misinterpreted or the market jumping the gun a little bit swiftly, but MUFG, which is the biggest Japanese bank, they are actually keeping the March rate hike in the possibilities. So being the biggest Japanese bank, the market adheres to it, and we're trading with a bit of a stronger yen, which is probably going to continue, or at least I'd say now we may see yen dip buyers into next week, and then waiting for the Bank of Japan afterwards. If we really get some decent solid wages, yen could trade quite a bit stronger, or at least stronger into the Bank of Japan, perhaps.
Tightest range I've seen for a long time, going back to February, where it's about 3 weeks here. I'm not going to talk about Apple because everyone's bearish. Apple was all over CNBC yesterday. So not going to talk about Apple, but I think the other important thing that happened was we took out 420 in the 10-year. Just one caveat. Look at what it's holding.
Yeah.
It's like the 200-day right there.
There's something that keeps hanging in the market after that Wallace speech that he gave last week, doing more shorter end and also the Treasury is issuing more short end than the longer side as well. And as well, I've got the impression that the market is trying to look perhaps to something dovish from Powell, and we are also in a big employment week. Everything turns about employment data this week, and we saw those employment indicators a bit weaker. So ADP is going to give us an ID. Jolts are going to give us a bit of a delayed ID, but then we have the NFP and we have Powell. Seems like the market is looking for signs of weakness to trade on the back of, and that transpires more in the longer end than really the short end right now. Although even the short end, the 2-year is back below where the dots are, right? So it's all looking like it could come back a little more to the downside. I think the market will have more ears to dovish news, dovish comments than outright bullish. But then again, it's still a bit of a flip the coin, and the options markets are anything but impressed. They're still very tight, so it's going to take something to break ranges, I think.
Yeah, I mean, this looks like a classic, first wave or an A, and this looks like a ABC, probably, some type of flag. It doesn't look great.
Doesn't look great. And good morning, guys. And
good morning.
Maybe what can help push us towards the edge of the range is the ADP data in like 5 minutes. So
grab it.
Yeah, I was going to say, this is, one of a couple pieces of employment data that we get today. We'll have the JOLTS data. We have the ADP. Ryan, what were your thoughts on the ISM, the employment component of the ISM yesterday?
Yeah, well, moving into contraction won't help expectations for Friday. Most definitely not.
Right.
And it's a consideration. Prices paid also came back down again, but new orders went up, so there was a bit of a counter there, and a lot of the comments were still fairly positive about incoming business and the weeks and months ahead. So it wasn't a negative report overall, but it's a big jobs week, so the market's going to take those little bits and pieces that it needs to focus on at any one time.
Right. And so here we got the employment picture, looking a little wobbly, and then, obviously ADP today, JOLTS today, weekly unemployment claims tomorrow, and then obviously the big non-farm payroll. And a lot of people are starting to think that maybe this is going to be where the jobs starts to show a little bit of, tiredness in this data. I mean, we're at historically, we're at unemployment levels that we haven't seen since the since Dale was like, I don't know what were you in back in the 60s, Dale? Like 100? Just kidding. Love you, man. Dale, are you there? Dale?
Yeah. It's almost like I'm a mind reader.
Yeah.
I knew I was going to
say that.
Yeah. So anyway.
No, seriously though, we haven't seen unemployment levels, unemployment down at these levels since like, I guess it was like the 1960s or 70s. It's been a long time. So, but can we sustain,
I don't remember.
Let me ask you this, Dale. Do you ever remember a jobs market this strong before, ever?
No, this COVID changed the world. So we, it's our first pandemic in 100 years.
Right.
So no. So as old as I am, I wasn't around in 1917 or whenever it was. No. So a lot of people don't want to go back to the office. They like our lifestyle.
Right. You got a lot of people working, jobs and maybe not working full time, and so a lot of the employment picture I think is going to hinge on, especially this month, on people are going to start looking at what full-time employment is, and also, wages. We're going to see if wages continue to be sticky. But I pulled up the data flash just so we can get a quick look at what the ADP is. We're looking for 150,000 jobs, or the market's looking for about 150,000 jobs. Kman, you got any guesses here going into the data?
Oh, guesses.
Yeah, let's get primed for non-farm payroll for Friday. Give me some guesses.
Okay, 110. Let's go.
Oh, all right. Damn, he's looking
we are
professional. You're looking
guessers,
a little
Kay.
bleak. I'm sorry, Dale. What'd you say?
We are professional guessers.
Yes. All right. So, what is your professional guess, Dale?
I really don't even have a guess on it.
Come on,
I don't guess at everything. I'm a selective guesser too.
Well, I know Ryan's going to guess. Ryan, what are you going to go with?
I'm going to go between 0 and 1,000.
No more than 1,000.
No, between 0 and 1,000. 0 and 1,000.
Wow. Okay. All right. Well, I'm. That's a really big guess. I'll go with 130,000. I'll come.
Speaking of guesses, I've just put the link to the NFP competition. That's the one that counts in the chat here on Zoom.
Yeah, and remember, guys, take that. You have to reply to the actual tweet, and Ryan's putting it in the chat box. Remember, you can win a month of ForexAnalytix. We give away what, three months of that. So yeah, 3. All right. So to the left, we got the dollar index. We have the S&P right in the middle, and we have yields off to the right, and we have just a few seconds, and here comes the data. Here we go. 130.
140.
Well, that's not as bad as I was thinking, but the dollar doesn't like it initially. I don't think the dollar is going to get much downside on that number, though. Revisions up a little bit. Yeah, we're not going to see much of a reaction here, I don't think. All right, that's it. I'll see you guys tomorrow. Just kidding. We got Powell today. What's Powell going to say? I mean, Ryan, let's talk about this really quick. Obviously, the dollar's not going to do a whole lot here. We have to wait for the Bank of Canada. We can talk about that here in a second, which I think we should. But let's start with Powell. It's Humphrey Hawkins' testimony. He's going to Humphrey Hawkins testimony.
They don't call it that anymore.
No, I know they haven't called it since Greenspan days, but we like to call it because that's how we remember it.
Who was Humphrey Hawkins?
I don't know.
Yeah, I think it's 2 guys.
I don't know.
Hubert Humphrey from Minnesota.
I don't know, but what are you guys expecting? I mean, is Powell going to be like? Is he gonna run around today? Which I don't think so. Is he going to run around and say that mission accomplished, or is he going to tell us that we've got more work to do on inflation, and that's going to weigh on the market a little bit? That's what I think. I think that he's going to come in and say we still have a lot of work to do, and that's going to give the market the idea that we are going to not see rate cuts immediately, or anytime here, before summer, and the market's probably not going to take kindly to that. That's my view. Ryan, what do you think?
Yeah, what he should do is reiterate what they said at the last FOMC. There was plenty of warnings in there. Jobs not done, all that sort of palaver. What he could say is some updated comments in light of the data that's passed since then. So that might be something the market is looking for. If he doesn't say anything like that and give any sort of comment, that's going to affect the market as well. So it's all about what he does say and what he doesn't say, and what he might say and what he might not say, which makes it clear. It makes it clear as mud. But I think the base case is that he reiterates jobs not done, still going to do more, but things are going the right way. And if they do, then rate cuts are going to come. But a bit like the budget today in the UK, this is far more bigger politically than other Humphrey Hawkins because we're in an election year. So, we've got to expect politicians to be pushing their campaign stances and the like towards Powell on this one.
That's great point. Kman, do you think it's even possible that he's going to come out swinging saying and really more like upbeat about the economy. Do you think that that's even a possibility today?
More upbeat?
Yeah, more upbeat, like almost like mission accomplished kind of upbeat beat.
Yeah, well, we have a hang on a minute. Mission accomplished could be seen as very dovish because that could be seen as all right. We have done it. Now we can start to look at the other side and cut rates. If he says that, I think it. I'm at least 15 or 20 bit on the number of times he's going to say data dependent. And I think he's just going to steer the course. That's my base case. And the surprise, and also I think what the market is lurking at, because if you look at the equity markets, if you look at the bond markets, the market would love him to talk about those little flags that we see in the employment indicators, but that's a bit of hopium, I think. So base case is still very much data dependent.
Okay.
Well, the market has already taken away the gains and yields from the 60-minute show. So who's running the show? Is it really Powell? He generated
the pendulum
pop,
is running the show. The pendulum, it just keeps on swinging.
I think who's running the show is the degenerate gamblers in Bitcoin. That's who's running the show right now, to be honest.
The bond vigilantes are running the show.
Yeah, I mean, the bond market's been really interesting. I thought we'd get this double bottom extension, and it's really yields have come off, and I'm not too sure what to do.
So
with the
that was
his
jawboning, Blake, when it went up to like 38% retrace. That was it. That was 60 minutes at big pop.
Right.
And the market's already taken it away. So how seriously is the market taking whatever Powell says?
I don't know. That's a good question. But right now the market doesn't really care about anything. I mean, let's stop and talk about the market for a second, the stock market. There is, there's a few pieces of data that, as ForexAnalytix subscribers are aware of, that we look at all the time, would be, we have the bias chart. We always talk about like where key levels of support are in the S&P. And then if you look at like the orders and options, this is what Ryan uploads every day. You can see all the big expiries that Ryan was just talking about, the 4.47 billion of euro-dollar expiring right where we currently trade right now. So it's no wonder that we're just kind of stuck at these levels. The S&P, really critical level support at 50-50. And notice that move down yesterday. We got the move below 50.75, right, which is the 38% retracement. Buyers stepped in ahead of this number. And that clearly shows you that while above 50-50, there is no reason to be bearish. Now, I think we can argue that there's some cracks in the floor. You saw like Bitcoin, your garden variety, 14% decline intraday in Bitcoin. That must have felt good for anybody who is long, right? This really big move that we saw yesterday. So you're starting to see some things, worry the overall risk picture. But as far as the stock market goes, it's game on. I mean, we're still in very shallow retracement bullish territory. No reason to be bearish unless you get below this blue line, which is at 50-50. I'm trying to wrap my head around today, is there anything that could really push us below that? And my opinion would be only if we have, if the market walks away, today thinking, man, we're not going to get a rate cut. We might not even get a rate cut in June. But I don't see that. I see that he's probably going to say we still got more work to do, but I think the market's still going to price in safety cuts from the Fed. What do you think can get us below that support in the S&P at this point? Ryan, do you have any picture? I know, Dale, I know you could probably go and highlight some stocks that, that are starting to weaken, what you did earlier with Microsoft and Apple. But what else can pull us below there? What are your thoughts, Ryan?
I don't know. It's got to be something, you know, that's really going to tip stocks over. At the moment, you know, even these moves that we've seen, as you say, you know, we're getting the bounce backs. You know, that support now is every time we test it, it just adds another brick to the wall, makes it a bit more solid. So yeah, technically it's doing the right thing. We're making highs, we're pulling back, refreshing the trend, and carrying on doing new highs. We've done that for the last 3 weeks. Until that pattern changes, it's going to continue. But right here, if the mood is going to change, it needs to get below that 50, 50, 50, 40 area and then start holding it as resistance. And then maybe the picture's changing somewhat. But until then, the trend is your friend.
Right. I mean, it's like, you know, I pulled up this chart, or I blogged about this, the RSP yesterday. This is the equal weighted S&P. That was my edge chart of the day yesterday. I mean, we just, you know, hit those highs and we're struggling. Pre-market, we're up a little bit, but I think this is going to be key, because if we start breaking above here in resistance, I mean, first of all, relative strength is divergent, but just because it's divergent doesn't mean we can't go higher in RSI. If this thing starts breaking higher, that means the broad market is probably moving higher too. And then that's just going to accelerate things even more. So keep an eye on the RSP, especially if we start breaking out. All right, let's go here. We have just a few minutes. Dale's going to have his you know, guest will be on here in about 6 minutes. I want to know, what is the best trade setup you have going on right now? Let's start with Kman. What are you thinking? What's like number one? What are you looking at? Tell me how I'm going to make money today.
Today in particular, I don't know, but I think the Bank of Canada is perhaps a bit of is going to be a bit of a risk, because I mean the real base case is for just being data dependent there as well, but I've seen a poll coming out where the majority of strategists are still bullish the Canadian dollar, and that is not really how this market is actually trading right now. So
good point.
I think there's a bit of a risk that if they would slide into a slightly more dovish picture, that the Canadian dollar get a bit of a hit on the head. I think 136 and a quarter. Then, if that goes, it's we could be off to the races in dollar Canada. And then you look at in context with what's been said on the yen side of things. Canadian, perhaps if they're dovish, but if they're neutral or hawkish, it's probably going to stay inside this range. And for the rest, I'm still short Swiss franc, and that's it. Just let it run until the SMB.
Yeah, you know, a couple of things there, a couple little nuggets. As far as the dollar CAD goes, the 136 and a quarter, it's the 618 retracement. You got 136.10 right here. It's bullish wedge. You know, that means consistent highs, higher lows. That means a bullish wedge. That means there's a stronger likelihood for an upside break than a downside break at this point, based on this pattern that we're seeing here. You're right. The Canadian dollar does look weak, and it's not just the dollar Canadian. I'm long this. I'm short Canadian dollars, have been for a while now, but we have this EURUSD. It's better charts right here. Show you this this really strong move, and even the EURUSD is been ripping higher over the course of the last couple of weeks, and you know, letting that run. And I think you're very succinct here in saying that, you know, the Canadian dollar has like zero traction at this point. And if you're even looking at the yen, the Canadian yen has come out of an ascending wedge. We have a bear flag pattern, and we actually just hit new trend lows in that flag pattern. So you can see it's, you know, it's a pennant flag. It still points a little bit lower. So maybe the Bank of Canada is going to be the driver today. You know, if they're slightly dovish whatsoever, it starts leading us towards, you know, their first rate cut, you know, we could see some Canadian weakness here. Ryan, what's your best trade that you're thinking of today?
sell your house, sell your kids, sell your body parts, chuck it all on Bitcoin, and forget intraday 15% moves, because that's apparently healthy consolidation. That's my best trade today.
So let's just sell it all. Forget that there was an outside.
I didn't say sell it all. I didn't
Bitcoin.
say sell it all. I haven't said which way to do it. You can when you got 15% intraday moves, you can do what you like with it.
Yeah, it's a little crazy, right? I mean, this is wild. I mean, we literally touched all-time highs within a tick, and we saw a massive, what is that, 14% reversal? I think that was 14% intraday.
14.7 or something, yeah.
That is nuts. That's a 14 and some change. Intraday move lower. We have an outside bearish outside day, and I'd be a seller right here. I mean, I'm not trading Bitcoin at these levels, but if I was long, I got up this morning, on the long side, I'd be like, okay, this is time to pull it off, and then you can always buy new all-time highs, right? That I think is a big warning. But currency wise or stock market wise, what are you thinking here, Ryan?
Yeah, we're talking about this with this BOJ stuff coming out now. I'm thinking about getting in some shorts dollar yen on a decent rally. If Powell gives us one, sticks it back in the 150s, that's going to be awfully tempting for me.
All right. Well, I'm gonna stay along your trade path here with the yen. I am short Swiss yen. That's how I'm expressing my Swiss shorts at this point. Unfortunately I got out of my Euro Swiss at 96 cents this week, and it's kind of trying to leave without me. But that's okay. I'm gonna hold on for dear life because I'm trading the Euro Swiss yen to the short side. And now that we're below the 50 DMA, we've got this range. We start getting outside of this range, we might see that 200 DMA here just on a simple range extension over the course of the next couple of days. So I am looking to play the yen to the long side. And that means short Swiss yen. I'm looking to actually add to my position. I'm up 100 pips, but I'm going to get aggressively short here in a bit. So that's how I'm going to play it. That's what I'm playing today. And the rest is going to be up to you. And Dale, I know you have your interview coming up. Hope you guys and gals got a lot out of this. Remember, we broadcast here every single day. We just saw some dollar movement.
I was just about to say that they're pumping up Powell's comments from his testimony. Bloomberg are splashing it all over their big red headlines. It's just what he said in the testimony. They're putting the lines up, and but algos are going to algo. So there's nothing new here. It reiterates the Fed needs more confidence in inflation to cut, likely appropriate to cut rates at some point this year. We
mission not accomplished just yet. Thanks, Gavin. Gavin's like, yeah, the Powell text is out, just as Ryan suggests. So, guys, keep your head on a swivel today. Lots happening. Remember, we still have Powell's testimony. His testimony may be out, but it's the question and answers from Congress. A lot of the members, they're going to be. Andrew pointed out earlier, they're going to be hell bent on, because it's an election year. They're going to be talking about inflation. He's going to be put under fire today. Bank of Canada later today. Jolts jobs data in about an hour and a half. Lots going on. So, like I said, keep your head on a swivel. And Dale, I'm going to pass it over to you, my friend. Thank you for your guidance every day.
And my best idea is sell a rip in the Dow to the breakdown of the rising wedge up around 38.9, 38.8, wrong over the highs, 39.3.
So you're just hoping we get a little bit of a rip in the Dow, and you're going to sell into it, yeah?
Yeah.
All right. That's it. I like it. Here's your trend line that you can sell right into, right around these levels. I think Dale's discussing, which makes a lot of sense. Probably right around here.
Okay, and we have Michael Kramer here today. Hey, Michael, how are you?
I'm good. I'm just trying to unmute myself.
Oh, okay. I could hear you.
Okay, great.
All right. So what's new with you? Happy New Year. I know it's March, but I haven't talked to you. How's the year going for you so far?
A little rougher than I would like.
Okay. Yeah. All right.
But
so what's on
it's not too bad.
So what's on the docket? What's your take on where we're at? Do you think the market's going to care about what Jerome Powell says? Because it seems like the market has a mind of its own anyway. That the market's leading Powell, isn't it?
Yeah, I mean, I was listening to your call for the last half hour or so, and I think it's basically the equity market is just trading for the most part like a credit spread, and right now you're seeing credit spreads really narrow, and essentially you have the equity market sort of reflecting that tightness in the credit market in terms of high yield debt trading at really tight spreads to treasuries and such. And so that's creating this sort of risk on like mentality in the marketplace at this moment. And essentially you saw credit spreads just totally break down right around the December FOMC meeting when the Fed sort of acknowledged that they would be cutting rates this year, which I think was a huge mistake on their part. They should have probably waited until March to do something like that. That would have bought them some more time, and it would have given them some more opportunity to see if inflation is actually on the right path, because a lot of data points that I'm seeing show that it's kind of stuck here.
Okay, so once you release those animal spirits, it's hard to get them back in the bottle.
Right, and so I'm hoping that although I read the text already, he kind of reiterated the same thing that he has been saying now for multiple times, and it's not really that it's falling on deaf ears. It's that we haven't really gotten a data point consistent enough at this point to get the bond market to see rates break out to the upside. I think we need 10-year rates to get above this 435 level to really see that those credit spreads start to contract, to widen again rather, and to see the market really worry about a Fed having to stay tighter for longer and the odds of a rate cut coming this year diminished. You get a hot job report Friday, and you get that followed by a 0.4% month-over-month increase in CPI for February, and that could very well be the trigger that sort of buries the hopes of even a June or July rate cut. And I think that's really what's needed at this point to sort of reverse things in this market.
Okay. Do you see the cracks in things like Apple, Google, yesterday, Microsoft, especially Apple and Microsoft being the two large, biggest companies out there market cap wise?
Yeah, I mean, basically, I don't. When I look at this rally, I keep hearing about how it's broadening out, and I don't really know what data points people are looking at when they come up with that assertion, because the data points I'm mostly seeing is how it's narrowing, and it's narrowed down to just one stock at this point, Nvidia. And so, the odd thing about yesterday was that you saw basically 6 out of the 7 stocks in the group get hammered, and Nvidia was actually up on the day. And all that is really just option mania every day in Nvidia. 850 is a big level in the options market for it, and as long as that level continues to hold, it's going to be really tough, I think, to break the equity market, because Nvidia is sort of keeping things. I mean, let's face facts. Nvidia going up 6% a day is going to offset any declines you're going to see in Apple of 1 or 2%. And so that's sort of one of the big issues here, right? Is that financial conditions right now are so easy, right? And credit spreads are so narrow that you're not seeing implied volatility moving up. And because implied volatility is not moving up, the cost of trading options is not getting any more expensive, and it's allowing this whole sort of frenzy, like animal spirit, environment to persist. And it's interesting because I've been sort of bearish on the Canadian dollar as well, thinking it's going to get back up to that upper end of the range, 130, 137 or so. and I've been looking for the Mexican peso to sort of put in a bottom here and turn the other way and start going back up towards the 18 to 19 area, and it just hasn't happened yet. Right. And so watching those two things also is because the Canadian dollar is highly correlated to changes in the VIX. And so and it makes sense when you think about it from a financial condition standpoint, because a stronger dollar is usually associated with higher with tighter financial conditions, and tighter financial conditions usually lead to a higher implied volatility level. And a stronger dollar also in the Mexican peso, it would certainly also, the Mexican peso has been basically tied to, if you invert the S&P 500, the Mexican peso is basically tied to the S&P 500. It's just a risk on gauge. And essentially, if you get the dollar strengthening, it should also help to tighten financial conditions. And essentially, you've seen rates and the dollar just stall out over the last couple of weeks. And so that's why the equity markets continued to have this risk on like mentality. And
what do you think would generate a dollar rally? I had 103.80 in Dixie as an important closing level for me, and the signal was yesterday, closed under 103.80 for the first time, and we're a bit lower again today. But my gut tells me that I don't really see the dollar falling apart here either, because I still think there'll be, like what you're talking about, potentially a USD MEX rally and another break in commodity currencies. So
I'll share my screen really quickly.
Yeah, okay.
I mean, this is what my chart looks like on the DXY.
Yeah, it looks like it wants to go lower and further ease financial conditions.
It kind of looks like it, but you can also see this is a big area of support in here.
Yeah.
So it depends. I mean, do we hold this area and do we bounce? That's the whole key. I mean, obviously, if you get if you get the dollar breaking down and rates going lower, it's going to be hard to really contain, stock prices. I mean, it's really just that, I think, unless the market starts picking up on something else, right, which would be that of a recession or something, or major economic slowing, which would be the opposite. But I don't think that the dollar or rates are in a position right now that suggests either or. I mean, you would need to really see 10-year rates break below, 380, and you would need to see, the dollar probably get below 100 before you'd start thinking about, it being a risk off signal, right? Where the equity market is, where the bond and currency market are sort of thinking about a bigger risk economically here for the country, for the U.S. And by then the S&P 500 could be at 5,600. I mean, so I mean, essentially at this point, there are certainly divergent signs. I mean, when you look at the dollar versus the franc, it looks like it wants to go to 90 cents. When you look at Canada versus, I mean, this is an important level right here with a break leading to a move back to 139. I mean, we have the Bank of Canada at 10 a.m., which is really going to be the most interesting, I think, of the two, which could even cloud the message, right, around what Powell is saying. Because if the Bank of Canada comes out and and their economy has been certainly weakening at a faster clip than the U.S. So if some reason they were to come out and be more dovish, and you were to see the Canadian dollar break higher, that could lead to the dollar strengthening, leading to higher VIX, leading to a sell-off in equity. So this is just a weird spot. And I think at this point, trying to it looks like the market could honestly break either way. That's how.
All right, so we're in an I don't know environment, coin flip, awaiting confirmation of direction.
Yeah, I mean, you need confirmation at this point. I mean, generally speaking, when you look at the economic data, it would suggest that 10-year rates should be going higher, and they're not. And I don't, and that doesn't really make me feel good.
Okay. So yeah, that 420 was important. If you put up the yield chart and you don't have a bias, and we all have biases,
Right.
that it almost looks like you had, you know, a very directional decline from 5%. And this looks corrective. You know, we didn't even get to 50%. Well, I think 440 was 50%.
Yeah, I mean,
Do
you're
we
sort of like got into no man's land, to be
Yeah.
honest. It doesn't really make for a nice place for it to really have stopped.
Yeah.
From when you look at it from an Elliott, you know, sort of Fibonacci sort of standpoint.
Yeah.
But you're right. I mean, this certainly looks more impulsive, and this certainly looks more corrective, I guess.
Yeah.
But you could also make an argument that this was corrective off of this rally too.
Correct.
Higher,
Yeah, you can.
know?
So, you know, I do have on yields, I think the 200-day is coming in right around the lows here that we've had.
Oh, it's possible. I
And
don't.
and then I wanted to ask you about the Dow. So the Dow doesn't have NVIDIA in it.
Right.
Is that why it's been weaker than the rest?
Yeah, I mean, I did an analysis. I've been doing these little side analysis on like on the different indices, and you know, the Dow doesn't have NVIDIA, so I think it's more reflective of what the actual market is at this point than, you know, what, you know, you're seeing in the S&P 500. I think the S&P 500 has just become another sort of arm of the of the Nasdaq. I mean, since, you know, you can see basically since December 15th, the Dow is up a big 4%. And since December 15th, you know, you have, I guess back here, you know, you have the S&P up almost 8, right? And that 4% delta is NVIDIA basically.
Right.
Or
so
that, you know.
So as NVIDIA goes, the market will go.
Yeah, and I mean, you might want to even throw in Wingstop there because for whatever reason, I found this totally odd. I mean, I did an analysis on this, and I mean, look at how much the stock has to go back to just to get to where it was on November 1st.
It's amazing.
Right? It has to go down 54% just to get back to where it was on October 30th. Right. And it has to go down at this point 20% just to get back to where it was when it reported results on February 20th. I mean, that in itself would wipe out, you know, 1 or 2, 2 percentage points off the S&P probably.
Yeah. Yeah.
But what's interesting is when you take Wingstop, which has nothing to do with GPUs. I mean, the charts are identical. They went from being inverse to being correlated. Basically starting right around October 31st, which of course was when our friend in the Treasury Department, you know, sort of changed the QRA and the way that, you know, the way that they were going to issue treasuries. If you remember, that's what sparked the sell-off that's what sparked the buying in the in the rate complex, and that's what sparked the move higher in equities was when, you know, the 10-year basically broke lower on rates after she sort of changed the way they were going to go about issuing debt.
Yeah. So do you think the bonds, I kind of think that there still could be one more dip in TLT, but they don't look bad. I mean, it looks like we couldn't even retrace 50% in TLT.
Yeah, I mean, I mean, the TLT, we're just looking at basically the 10 and 30-year inverted, right?
Yeah,
so
right.
Again, you just got to get, you know, you get below 92 and that's another story. But I mean, at this point, you really haven't seen, you know, you really haven't seen much happen. Maybe there's even a bull flag for me here. I don't know.
Yeah, it looks like consolidation after that big run.
Yeah. I mean, I've been sort of in the mindset that rates are just going to stay somewhere, you know, on the 10-year, call it. I mean, ideally, I think rates should probably be somewhere in this 4.25 to 4.75 range in here and just kind of live in this zone. But it's, you know, maybe that zone is really more in the 3.75 to 4.25 range. I don't really think that rates are going to break significantly lower because there's just not enough the economy is still too strong really to warrant rates on the back of the curve moving down. And, you know, I mean, at some point, I mean, shouldn't the yield curve steepen? I mean, this has been, I think, one of the longest. I mean, you've been doing this longer than I have, but this has to be one of the longest and deepest inversions we've had in who knows how long, right?
Yeah.
It's just not, it's not like normal to see a yield curve inverted for this long. And for it not to, I mean, these are previous inversions I have marked. I mean, I'm being generous here by saying that this inversion lasted 560 days when clearly it just kind of went back and forth for a while. This inversion was only 336 days. This inversion was 511 days, give or take, again, being sort of generous. And this one has been already now, you know, even longer than that. So, I mean, it's sort of bizarre to me. I mean, this is the longest inversion we've had, 623 days. So, I mean, since, you know, 1989. 1989.
29.
29?
Come on, say 29.
29. Why? Because that's better.
All right. So, okay, how about the longer the inversion, the bigger the consequences?
I don't know. I hope not.
Yeah. Yeah.
I mean, just because I'm bearish on the market doesn't mean that I want, you know, a recession or something worse. Like, I would like to see just valuation sort of return to something that's normal, you know, across the marketplace. I think that's really the key here. I mean, is like, I would love to see a bear steepener where you just saw the 10-year rise to something like 5% and the 2-year come down to maybe 480 or something, you know, and just get back to something that's somewhat normal and not have like an economic chaos. Just have it where the Fed can just actually do its job the right way. Get rates back. What?
Could it happen in this environment? Could it happen?
It could happen. I mean, certainly the economy is strong enough, right?
Okay, yeah.
But the market needs to cooperate. The market's not helping.
Okay.
The longer financial conditions stay easy, the bigger the risk you have of the Fed making a policy error. Because if we just look at, you know, what the inflation swaps market is telling us, I mean, the CPI rate's expected to be at 3% come June of 23. I mean, this is a big change from where we were, you know, a month ago. You have to move these dots over one, you know, so this dot here is equivalent to this dot. So, I mean, we've seen a 60 basis point move higher in inflation expectations in 1 month, right? When you look at 1-year break evens, I mean,
go ahead.
You've seen that these have just gone, you know, through the roof.
Wow.
When you look at even 1-year inflation swaps, those have started going up too. And so all this is telling you that inflation is sort of reaccelerating here, and that's another reason why I would think that rates should rise and the dollar should strengthen, right?
Right. Okay. What's the message you're getting from the move in gold?
It's certainly not deflationary. It's certainly not disinflationary either.
What's the message? Bitcoin and gold.
They're telling you that there's still there's still too much liquidity in the system. Gold is telling you that rates should probably go higher. And Bitcoin is telling you there's just too much excess. There's still too much money in the system. Maybe that starts coming out next week when the bank term funding program ends.
Yeah. I mean, that chart doesn't look bad either, KRE.
The KRE?
Yeah, it doesn't look terrible.
No, it doesn't. It could be worse.
Yeah, you know, almost looks like the bonds, the yield chart. So maybe that's why the inversion's still there to help these guys out.
No, I
Does it
mean,
help them?
I would think it would be the opposite.
Okay.
They really need the curve to steepen.
Okay. All right. So really the big takeaway is financial conditions are too
They're too
loose
easy.
still, and may be about to get looser if the
Maybe.
dollar breaks down and yields keep heading lower.
I mean, I hope that doesn't happen, because I think I'm just gonna go and disappear for a while here.
Well, maybe we're going to have a blow off to 6,000. I know some people even talking 7,000 S&Ps.
I mean, I know that there's always those risks and everything.
Yeah.
In my mind, I would probably, not want to be around for that, because what comes afterwards would be really. I mean, you can see the financial conditions. This is over a percentage. This is I'm trying to see 1-day Z-score. This is on a monthly chart, right? So this is a 1-month decline. We had the biggest easing of financial conditions since 1980, right?
Wow.
It was like the Fed already cut rates. The Fed doesn't need to cut rates. The market already pulled forward 6 rate cuts for the Fed, basically.
Yeah. So the market, that's what I mean. It's the Fed becoming less relevant than the market, that they're just following the market. And he'll adopt his message to what the market's doing. I mean, after 60 minutes, we had that bump up in yields. And since then, we've taken all of that away from his 60-minute appearance.
Yeah, because I mean, honestly, he keeps sending out these guys and they keep saying the same thing. Oh, we're looking for rate cuts. Stop with saying you're going to have rate cuts this year.
Yeah.
The only one who's kind of changed the message recently is what's his name? Barkin, I think, said that maybe there wouldn't be any if things continue. But I mean, and now you have Bostic sort of coming out saying, well, we could cut once, but then we would pause. I mean,
all right. Yeah.
Unfortunately, this is starting to look like could potentially turn into a repeat of the 1970s.
Yeah.
I know that we don't have much more time left, but look at what shipping rates have done. I post these charts on Twitter all the time. I mean, look at what shipping rates have done over the last. I mean, this is going from 1,400 to 3,400, right? That's more than a 100% move. Look at what the Baltic Dry Index is doing, right? I mean, this is going to feed into goods inflation. The only reason why we've had any disinflation at all so far
China
is because you've had goods disinflation and you've had energy prices collapsing. But I mean, look at the move you're having in Baltic dry freight. It's moving back up pretty aggressively. Look at the price of gasoline. The average price of gasoline this month alone. I mean, it's only the 6th day of the month, and gasoline prices this month are already up, almost 4%. That's following a 4% move, 4.5% move last month, and another 4% this month.
And diesel has even been stronger, hasn't it? Is that the blue line?
No, that's the RBOB.
Okay.
Diesel I have here too. I don't know what diesel's done. No. Diesel it had a move, but it looks like it's getting ready to go higher too.
To go again. Interesting. I tell you, Michael, I learn from you every time I talk to you for half an hour.
It would be great though if the market actually sort of traded with these things, though. It'd make my life a lot easier.
Yeah. Well, if you go away, I'll meet you on Jekyll Island. You ever read that book?
No.
Oh, yeah, it's about the Fed, Jekyll Island. It's not Heckle and Jekyll, and you're probably too young for that cartoon.
Heckle and Jekyll, yeah, I remember that.
You remember that? All right. I have a question. Does liquidity in the equity market give any support for the dollar to surge? What do you think?
Well, they usually work in inverse of each other, right?
Yeah.
So I would probably say no. I mean, if anything, if the equity market's rising, it's probably because the dollar is falling, right? You have more of a risk on mentality, so you probably have more of a movement into those emerging market type currencies and away from the dollar.
Okay. Well, Michael, thank you so much for coming in here every quarter or so, and you have insights and wisdom that open my eyes to things that before I talked to you I wasn't paying attention to or knew about. So thanks for edifying the whole community. We appreciate it.
Not a problem. I always enjoy coming on with you, Dale.
And 2024 is still early in the year, and every dog has its day. That's what I say.
It's true. Markets goes in cycles, and the pendulum always swings one way too far to the other. It's just knowing where it's gonna stop swinging.
Yeah, never seen a rubber band this stretch without snapping, but we'll see.
Unfortunately, I have. If you remember, the late '90s was very similar.
Oh, that's right. Yeah, I can't even remember that far back, but
I have good memories of those times, but it was afterwards that I don't really enjoy remembering.
Yeah. Well, you know what? When it comes, you'll be there. And to be there for the good times, you have to be there all the time. So you can't take a vacation, bro. You have to just gut it out, and I'll talk to you later in the spring.
That sounds good to me.
All right, Michael Kramer, everyone. Follow him at Michael Mott CM on X. Go to his website and learn about the inner workings beneath the surface of debt and equities, and pays a lot of attention to currency action. So
I do.
Check them out. Check them out for your intelligence gathering.
Thank you, Dale.
All right, buddy. That's a wrap, everyone. Don't just count your yields, count your blessings, and you could join the team in 15 minutes on the Morning Edge. And we'll see you tomorrow. Enjoy. Oh, Jerome Powell. He's not Paul Volcker. Is he Arthur Burns? Is he bipolar? We'll see today. Adios, everyone.